Oh, we're live. You see this? No, I'm really not shaking like that, but I just drank a Celsius and I'm literally buzzing right now. And you're drinking yours.
Yes, I decided to try that when I entered the office and it was sitting in my seat versus having my usual cup of coffee. This one is like having 3 cups of coffee.
Yeah, Wesley made me do it.
Happy Casual Friday to you. It is May the 12th, and we are live for the Jack and Bill Show. So I guess it's been a while since I sat here. Thought it'd be a good time to just talk about some of the things that are going on that have been going on in the last few months. We're still so last year, we had the Fed tightening like crazy because they got behind the curve on inflation. This is still the theme. The $64,000 question is how long is the Fed going to keep tightening? And I'm going to answer that for you. They're going to keep tightening until inflation falls to normalized levels, 2 or 3%, or B, they break something. And yeah, so and we're seeing we're seeing.
I'll take the other side of that.
What's the other side of that?
I think they're going to continue tightening based on data, but I don't think they'll continue tightening until inflation hits 2%, because I think they've already kind of signaled that normal inflation is higher than 2% in this environment. And I think something's already broken, and we're seeing it with bank failures.
Yeah, that's what I'm saying. So if we got into, full-on contagion, something like that, the Fed would have to go the other way to unwind or try to fix the mess that they've made. But I think, there's been a theme that they've been behind this from day one.
Yep.
And the numbers, so we just got CPI and PPI this week, and the market was kind of a little bit excited about that. But we went from 5% year over year consumer price index in March to 4.9% in April. Now, estimates were higher, but it looks like things have gotten really kind of sticky. And there have been, at least in the last 6 months, the talking heads have been saying that looks like the Fed's done. They're going to be easing later this year. And that's what they're saying now. And they've been wrong about that every time, because this inflation has been coming down, but it's been coming down way slower than I think the Federal Reserve anticipated. But yet we've still got, we've had GDP growth of 2.9% and 3.4% unemployment, which is kind of inflationary, at least on the employment side, although there's some signals that, we could have higher unemployment in the days ahead. But that's where we are. And last year, with the stock market down, depending upon what index you're looking at, S&P down 20%, the bond market down 15%, we've seen a reversal. The darling stocks last year were value stocks. This year, it's tech again, and the NASDAQ. So the Qs are up 20-something%. The S&P 500 is up 8.2 through yesterday. Call it 8 or high 7s, given market action so far today. And Dodge & Cox Income Fund, bellwether, widely held intermediate term investment grade bond fund, is up 3.7% year to date. So, but I'll tell you something interesting, Bill. See, and love to hear your comments on this. You could take the S&P 500 and break it into 2 sub indices. The S&P 7. The S&P 7 is Nvidia, Microsoft, Tesla, Alphabet or Google, Apple, Amazon, and Meta or Facebook. Those stocks sell at 30 times earnings. And this year, everyone is enamored with pretty much every one of those stocks. Even though Tesla's come back some lately, it's still up something like 45 or 50% this year. Amazon and Apple are both up, I think, in the 30-something% range. Meta has rebounded from getting killed last year. So then we're left with the S&P 493. S&P 493 trades at 16 times earnings. That's something I'm much more interested in,
I
me
agree.
personally, than the S&P 7. But what do you think is driving this?
Well, let's take a step back. What's driving the S&P 500? And you just, in a roundabout way, explained it. So the S&P 500, which is the big index that we look to for benchmarking portfolio performance, it's the standard, really. It's being overly influenced by a handful of mega cap growth stocks that are trading for high PE multiples. And it's really not representative of the overall stock market for that very reason. Be careful of that stuff. I mean, you will literally buzz. Anyway, but that's a phenomenon that's been going on for a number of years, and that's why we've seen growth stocks outperforming value stocks over the last decade. I think in this environment, people are willing to pay up for growth, and that's what we're seeing. With these mega cap growth names, people are willing to pay higher multiples, and as long as these companies are delivering, people will continue paying up for the growth.
Well, that's kind of one of the definitions of a growth stock, is that in spite of what the business cycle's doing, a good growth stock is always going to have earnings.
Yeah.
And but I think there's something else. I've just noticed this, Bill. I don't profess to be someone who understands technology at all.
Amen.
In fact, I wish that we could go back to like the dinosaur age.
No.
So, because I've just about given up trying to keep up with this stuff. Although I'm gonna have to do a better job.
Just about giving up?
Thank you, Wesley.
So, but I keep hearing this artificial intelligence thing, and I think of comments I heard that got a lot of attention from Elon Musk, even a few years ago, that we weren't far. Right around the corner was the interface of artificial intelligence and the human brain, and the dangers of it. Like, picture these robots, that dog-looking robot thing that everyone's seen, fighting future wars for us, and things like that. And then a lot of what I'm hearing most recently,
It's like the Terminator movie.
Yeah, like the Terminator movie. And then wasn't that prophetic? And then now they're saying that there's a huge danger that AI all of a sudden it's in the news every day. I've got people asking me, how do we play AI? What are you doing to make sure you've got exposure to AI? And I had a friend and client ask me that, last week, and he's probably a guy that if you're waiting to jump into this stuff, oh my God, I'm sending a text message. I'll send it to him.
Yeah, while we're filming.
Well, look at that. I'm gonna have to tell him I'm sorry.
Tell the audience you're sorry. All right, I'll pick up here. Okay, so I'm getting questions too about AI and how to play AI. Generally, when people are talking about a theme like this, it's because it's getting a lot of press coverage. And so we are seeing AI making news magazine covers and getting a lot of headlines. Here's the thing about thematic investing. When something new comes out, a new technology, there's generally going to be a lot of interest initially, and there will be a lot of players coming into this new industry.
Recklessly.
Well, but it's just part
Oh,
of
I mean the investors.
Right.
Sorry.
But as far as the actual players in the industry, with a new technology, there's going to be a lot of players initially, and then over time it dwindles, and most of those companies fail. And you end up with just a handful that survive that process. And in the meantime, you've got a lot of investor money that is blown during that process. It's very speculative, is what I'm saying. With any new technology, we've seen this time and time again. 3D printing was one. Cannabis was one. That's not a technology, but
these are, I might interrupt. These areas that you're mentioning are profoundly difficult for an investor
Yes.
to make money in.
exactly.
Because they get hyped up so much. I'm look at the cannabis stocks. I mean that industry has grown tremendously, but it got so
the
overbought.
stocks got destroyed.
Most of those stocks probably lost 70 or 80% of their value. And
Right.
and a few of them are only looking attractive.
So I mean, that's
Yeah.
that's the risk of buying the hype. If you look at crypto, all of these different crypto coins and currencies that came out, most of them failed, and there's only a few that remain that are viable. So it's a very speculative endeavor if you're looking to do that. On the other hand, there's other ways to get exposure to it directly and indirectly. Think about companies that are involved in that industry, like, can you think of one? What would you guess of a viable company involved in AI?
Okay, I'm just going to tell you because this is a conclusion that
Mhm.
I've kind of made here about dividing up the S&P 500
Mhm.
into the 7 and the
There
493.
you go. You just kind of answered it.
I think that some of these names are way up this year because of all of this talk about AI.
Okay.
So those are actually the seven largest market caps. That's shares outstanding times times the share price, and that's Nvidia, Microsoft, Tesla, Alphabet,
Correct. And you would
Apple,
expect
Amazon, and Meta.
you would expect all of those companies to be involved in AI in some way.
Yes,
Absolutely.
absolutely. I mean, those are considered tech. Nvidia software, Microsoft, same thing. Cloud, AI in EV automobiles, Alphabet, search engine, Apple iPhones, Amazon's more retail. But imagine they're in so many different areas. They're kind of taking over the whole world. So you would think that they're very interested in this. And then social media marketing, as well. But there's going to be, and here's the thing that I would say to anyone out there, and that's what I told this gentleman. If you try to cherry pick, hey, if you want to buy Tesla because you want exposure to AI, I would argue that that's not a really good way to do that, because you're basically buying an electric vehicle company. Or the same thing with, Apple. If you wanted to make it more of a pure play, I mean, this isn't really pure, but I would say to take a shotgun approach. Like I just noticed, I am not recommending this, but like Wisdom Tree, for example, and you're going to see this from all of these ETF asset management firms out there. They've got one, it's WTAI, Wisdom Tree, Artificial Intelligence.
Oh, no.
Oh, yeah. And they have like 50 plus names in there that, including all 7 of the ones that I just mentioned, and a whole lot more.
You know what I've found in my experience, and you probably have too. When you see Wall Street firms rolling out products to capture a specific industry like this or a theme, it's generally too late.
Time to run.
Time to run, because their job is to bring in assets. And so in many ways, they are responding to demand instead of leading with, hey, this is where we really need to be. It's all about, well, this is what consumers want. Let's give them what they want.
Yeah.
I'm a little reticent about that.
Yeah, me as well. So, so those are just kind of some overall themes that we see going on in the market. We are seeing, again, you know, what's really going to drive this is market gains, both in stock markets and the bond markets, is our Federal Reserve's response to inflation. So, and you know, what's happening with the inflationary numbers? Is it going to require, you know, more of a response? And the market is kind of hinging right now, and it's like you said, it's data dependent. We have the federal funds rate at 5 to 5.25 right now, which is, I think, the highest it's been in something like 16 years. We've had an inverted bond market for probably a year and a half now. It has been steepening sharply as there's speculation now, and the futures markets are indicating that the Fed will be easing sometime in the third quarter. I'm not so sure about that.
That's what the market believes.
But that's what the market believes that right now. And that's going to shift and change as we're confronted with new data releases, namely unemployment, GDP growth, the jobs numbers, the first Friday of every month, you know, and then CPI and PPI, which come out monthly. So the market is really focused on that. And then I think, I don't think that this banking crisis really has a lot of legs from here, but this is a situation. Why don't you tell everyone what's been going on with like cash sorting, Bill?
No, I mean, I think everyone understands it. I mean, everyone's aware of it. And that's anytime we have big headlines about a bank failure or a potential bank failure, and the markets get spooked. You know, the question is, you know, what's driving it? And, you know, the cash sorting, it's part of this asset liability mismatch. Banks take in deposits. Well, for you as the customer, that deposit is an asset. For the bank, that deposit represents a liability. You are, in effect, making a loan to the bank when you put money on deposit at the bank. And it's just a shame that for many, many years, you didn't get paid anything on that loan. You were making interest-free loans to the bank. Well, the banks were taking customer deposits, not paying really anything on those customer deposits, and then they would do what banks expectedly do: make loans with that money and or invest that money. Well, banks haven't been doing a whole lot of lending, but they have been investing. Now they've been investing in high quality things because after the credit crisis, new regulations put a damper on the kinds of things they can invest in and requiring banks to upgrade the quality of their investments. So these were not bad investments, but they were making investments when rates were lower. So last year, when rates started going higher, these fixed income or bond investments fell in price. And at the same time, customers were cash sorting. They were pulling money out of banks because they weren't getting paid anything on it and taking that money and investing in money market funds, T-bills and the like. And so banks were then forced to sell investments at losses to redeem these deposits. And that was the big driver of demise for Silicon Valley Bank and other banks are
Signature Bank
too.
in New York, Silicon. Yeah, when they had all of their treasuries held in the held to maturity, that they had to liquidate at roughly 20% losses. I think it was something to the tune of about $50 billion worth. And when they cashed them in, they were upside down by several billion.
And you can't
So-
blame the depositors. They're doing what's best for them.
Yeah, absolutely. So there's likely going to be a few more of those that come out. I noticed seems California has their share of these things. PacWest Bank Corp was down 23% yesterday. So I think today some of these things are trying to rally, but we're going to have to work through this because all these things are black boxes, and you don't know what these banks really own either. But I think ultimately we're going to wind up moving like a place like the UK that has 5 or 6 banks. JP Morgan Chase and Bank America are huge beneficiaries of what's been going on with the smaller banks. But the bank, it is a very important issue because the banks are the engine of our economy. And it's very difficult for the stock market to do well when the engine is not thriving. And but you've kind of got this shifting around where which I don't really like this or care for this. These behemoths are becoming gigantic behemoths.
Giant behemoths.
Yeah. So
Well,
But
I still say there's a role for local banks, and local banks serve an important part of the economy, small business, and these local banks know these businesses better than any other financial institution could. And the local banks, they're just doing what they're supposed to be doing, blocking and tackling, banking their customers. They're not getting into the crazy stuff that got all these institutions in trouble during the credit crisis. And they're managing their financials the way they're supposed to be. But it is unfortunate that you have a handful of these regional banks like Silicon Valley who are doing things they shouldn't be doing. Their board of directors, their officers are not managing the bank properly, and it impacts the whole industry. I hate it.
well, we've had the whole world turning towards this environmental, social, and governance framework that has that's very controversial right now. So, and I even noticed this flying on a plane a week ago, reading annual reports, and they're putting that in there. There's actually charts in annual reports now about the board's sexual preferences and things like that. I mean, what have we been coming to, and what they're doing about all this, which I think that both Signature Bank and Silicon Valley National Bank, it's very easy to point the finger at them for getting way off track and trying to be politically correct rather than having policies that work for any sound bank. And I think we're going to see some more shifting with that. And another thing, Bill, might throw this out. We're going to be out next Friday, and Bill's doing a due diligence conference with an ETF provider.
And you're going to be out. You're going to an ESG conference, right?
Not hardly. No, actually, they did have an ESG speaker when I went one time, but I'm going for a due diligence conference in New York City for a business development company known as a BDC, and this is an area where the commercial banks got away from making adjustable rate loans to mid-market America because we got a few administrations ago, after the subprime crisis, we had so much regulation that came in that made it prohibitively time-consuming and expensive and just not ideal for commercial banks to make these types of loans. So So now these companies, business development companies, they're called, work alongside private equity. And we own one that we got in on the ground floor with that we really like. And I actually think that this space is something that makes a lot of sense if you can focus on the ones that have high quality and don't charge too much. So we own a very high quality one right now that's paying 8%, and if the Fed keeps raising rates, they have to pay it. They have to pay you more interest. So so that's the thing. In conclusion, with that, I would say, you know, what do we do with all this? We're in a market that's a little bit fragile. We recommend that people really need to be diversified. I would hate to be a do-it-yourself investor in this climate. Also, I would just make an advertisement. The banks are not a good place to have your cash right now. And we've got some great ideas of how to make 5 to 6% or more on your safe money. And we can do that easily and give you tremendous liquidity. So, well, Bill, I think the LSU Tigers are ranked number 1 in baseball right now. They
got bumped down.
Maybe they did get knocked down.
They're still up there.
They had they've only had one outing where they didn't win, you know, at least 2 out of 3 of the games.
Was that Auburn?
I think that was at Auburn like last weekend. But I'm more interested in the SEC track and field meet is in Baton Rouge going on right now. It began yesterday. The LSU men and women are each ranked 6th nationally. I think they're going to do better than that. And I wanted to take my brother's son down there, but it's not going to work out. But anyway, go Tigers. If any of our viewers have any questions about any of this stuff, stop in, give us a phone call, and we will be in touch soon.